Okay, here is problem 5-1B. This should be very similar to the second to last problem on Chapter 5, assignment number 2. Cray Distributing Company completed these merchandising transactions in the month of April. At the beginning of April, the ledger of Cray showed a cash of $10,000 and common stock of $10,000. So it looks like they're a new company that had funded with some, the owners had bought some stock, and that's where they had their money from. So here's all the transactions. Then it says Cray Distributing Company's chart of accounts includes cash, accounts receivable, blah, 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 blah. Number one, journalize the transactions. So we should be getting pretty good at journal entries by now. So I'm not going to explain them very in depth. I'm just going to kind of go through them here. On April 2nd, they purchased merchandise on account from AM Bev Company, $8,700. Terms are 210 net 30. So we're going to call it April 2nd. And we're going to say our inventory, remember this is an asset, increases 8,700. And our accounts payable increases 8,700. On the 4th, sold merchandise on account, $6,000, terms 210 net 30. The cost of the merchandise sold was 3,700. So remember, when we sell merchandise, we have a 4-part entry here. Whoops, it's not the 4th of ARP. I don't even know what ARP is. I guess it's an association of retired people. Anyway, that's better. All right, so we're going to show accounts receivable because we sold it and they owe us of $6,000. And we're going to show sales revenue of $6,000. Also, on 4th of April, we're going to have cost of goods sold usually this is just abbreviated COGS, cost of goods sold, of 3,700. That's the cost of the goods that we sold. And our inventory will decrease by 3,700. On the 5th of April, we paid $200 in freight from the April 4th sale. So again, this was a sale, so we're paying the freight for our customers. So we're going to list this as an expense called freight out for $200. And our cash will go down by $200. If we paid freight on something that we were purchasing, that'd be different, and we would add that freight cost to our inventory. When we pay freight on something that's going out, we just record it as an expense of the period. That's the standard convention. All right, received credit from AM Bev Company for merchandise returned, $400. So our accounts payable will decrease by 400. That means less money that we have to pay back. And our inventory will also decrease because we sent the goods back to them. On the 11th of April, we paid them in full less the discount. So we have to figure out how much the discount is. So let's think about it a little bit. When we purchased it, it was $8,700 worth of stuff. Then we reduced that by $400. So the net amount we owed them was $8,700 minus the $400 after the credit from April 6th. So that should be $8,300 we now owe them. And then the terms of our purchase were 210 net 30, meaning we would get a 2% discount. So the total amount we have to pay them is 98%, right, of the original 8,300. Or that would be, you could also figure it out by doing 2% times it and then subtract that from the total amount. Anyway, so on 11 April, our accounts payable, the amount we owe, which has a current balance from this transaction of $8,300, on the credit side will go down by $8,300, meaning we don't owe them anymore. But our cash will not go down by the full $8,300 because we got a purchase discount. So it will equal $8,300 times 0.98, or 98% of the total because there was a 2% discount. So 8134. Then our inventory will be decreased, because remember when we made the original transaction up here, we recorded the full 8,700 going to inventory. Then we subtracted off 400 from inventory when we got the return, leaving 8,300 in inventory. And now we have to recognize that since we recorded this at cost and we're getting a discount on the cost, we have to reduce the cost from our inventory even more. And this will be the 2% discount. So this will be 8,300 times 0.02, or 166. You'll notice that the cash that we paid out minus any amount that we're taking out of inventory because of the discount should add up to the decrease in our accounts payable. All right, on the 13th of April, received collections in full less discounts from customers billed on April 4th. So on April 4th, remember we billed them $6,000. We also gave them terms of 210 net 30, meaning they could take the 2% discount, which they did. So now we have to record that. So our cash is going to increase not by the full $6,000 that they owe us, but by 98% of that $6,000. And the amount of their discount, which we're going to actually list as an expense. Actually, it's not an expense. I take that back. It's a contra revenue account. But it offsets the revenue. Is going to be the 2% discount. So it's going to be the $6,000 in total sales times 2%. That's the amount of the discount. And then our accounts receivable will go down by the full $6,000. If you're ever confused about this, you can just calculate the amount of discount and know that the accounts receivable goes down by $6,000 and that the transaction has to be in balance. So the difference between the account receivable and the amount that was discounted, the 2%, is the amount of cash you received. That's another way to look at it. 14 April. Purchase merchandise for cash, $4,700. So inventory increases. Cash decreases. 16 April, received a refund from the supplier for returned merchandise on the cash purchase April 14, $500. So our cash will go back up, and our inventory will go down. 18 April, purchased merchandise from Lure Distributions, $5,500, terms 210 net 30. So our inventory will increase, 5,500, and our accounts payable will increase 5,500. On the 20th, paid freight on April 18th purchase of 180. So here's freight paid on a purchase. So we're going to add the cost of that freight to our inventory, $180. And paid in cash, so our cash will go down by 180. 23rd, sold merchandise for cash, $8,300. The cost of the merchandise sold was $5,580. The cash will go up, $8,300. The sales revenue will go up, $8,300. And then the other side of that is my cost of goods sold. Remember, that's an expense. Will go up by $5,580. And my inventory will go down by $5,580. So for each transaction, I get cash and my inventory goes down. I have to record the revenue that equals the amount of cash I received, and I have to record an expense that equals the amount of the cost of the goods that I'm selling. 26 April, purchase merchandise for cash, $2,300. Cash goes down. 27th, paid Lore distributors in full less the discount. So let's figure out back to where we purchased from Lore. 5,500, 210 net 30. If we paid them on the 27th, we got it within the 10 days, so we get the 2% discount. So it'll be our accounts receivable. I'm sorry, our accounts payable. We'll go down by the whole amount that we owe them, so that we don't owe them any more. The amount of cash we have to pay is 98% of that. And the amount that is our, we're going to deduct from our inventory will be the other 2%. Again, you can always say what's the total amount of accounts payable minus the inventory, and the difference would be the amount of cash I have to pay. Remember, we're just taking this cost off of the inventory because when we recorded the inventory, the purchase originally, we listed all 5,500 as an inventory. And since this represents our cost of the inventory, then when we get the discount, we've got to subtract that back off. 29th, made refunds to cash customers for returned merchandise, $180. Returned merchandise had a cost of $120. So we're going to list that as sales, returns, and allowance. Another contra revenue account. Our cash will go down by 180. We also have to show that we're receiving that back into inventory. So our inventory will increase by the cost, 120. And our cost of goods sold, which is an expense, will decrease by 120. 30th of April, sold merchandise on account, $39.80, terms net 30. The cost of the merchandise sold was $2,500. So our accounts receivable will increase by the amount of the sale, $39.80, as will our sales revenue. And our cost of goods sold expense will increase by the cost of the items, $2,500. And our inventory will decrease by the same amount. There's our journal entries. You know what they're going to tell us to do next? They're going to tell us to make a T account and figure out the balances of all these accounts. Yeah, we know how we're starting to figure out their methodology here. So again, I will pause this so you don't have to watch me type out all of those accounts. All right, I've got all my T accounts drawn, and now I'm ready to transfer over my journal entries to my T accounts. So here I go. Again, I'll do the first couple, and then I will just fill them all the way over so you can see the end result. I don't think any of you need to see me do this, but I'll do the first couple here anyway. Inventory had a debit of $8,700, and accounts payable had a credit of $8,700. So we'll have inventory on the second, a debit of $8,700, and accounts, what was it? Accounts payable, I believe, had a credit of $8,700. Next, we have accounts receivable, has a credit of 6,000, or a debit of 6,000, and sales revenue has a credit. So 6,000 on 4/4, and sales revenue has a credit of 6,000 on 4/4. And then the other part of that transaction, cost of goods sold, it's a debit of 3,700, and an inventory has a credit of 3,700 on the same day. So cost of goods sold and it should be inventory, no, yes, our inventory going down by 3,700 on 4/4. One more. On the 5th of April, we have freight out. That's an expense of 200. 4/5. And cash going down by 200. So cash, we're going to credit. You know what, I think cash had a balance, so I'm going to say had a balance of 10,000, as did common stock. All right. Now we had the freight out, debit of 200, and cash credit on 4/5. Now I'm going to pause it, and I'm just going to fill in the rest of these going down line by line. All right, I've transferred over all of the journal entries to the ledger here, and now all that's left for me to do is to get the balance of each of these ledgers. So I'm going to do balance as of 4/30, and again, we would expect that this would equal the sum of all of our debit sides minus our credit side. We'll do the same for each account. I'll show you a way to make it a little bit easier using the auto sum feature, and then telling Excel we want this to be the sum of the debit side minus the sum of the credit side. For the liability accounts, we would expect the opposite, that the credit side would be larger because that's the normal balance for a liability account. This will equal the sum of our credit side minus, and it looks like we have a zero balance in our accounts payable. I like having a zero balance in my accounts payable. Common stock balance will be $10,000. Sales revenue, sales returns and allowance. Oops. Sorry about that. Hope I didn't freak anybody out right there. You always have to be careful when you're copying and pasting. Cost of goods sold is an expense account, so we would expect it to have a debit balance. So this will equal the debits minus the credits. All right, there's all my balances. So now let's take a look back at the problem, see what they want us to do next. Compare the income statement through gross profit for the month of April 2014. So it looks like they don't want a full income statement, just the income statement through the gross profits. We don't have to do all the rest of it. So here's how we'll do it. I'm just going to do it right here on this page so you can see it. We'll list first section. Let's just do this right. Since it's a partial, we'll say for the month ended April 30th. All right, so the first section will be sales. It will include sales revenue. Then we'll do less sales returns and allowances. And we will do also less discounts. Scooch this in a little bit so it's easier to see. So our sales revenue, we can look right here on the sales revenue account and see that it had $18,280 as the balance. Let me tell Excel that we're working in dollars here. Oops, I put that on the wrong line, sorry. All right, our sales returns and allowances were 180, and our sales discounts were 120. So our net sales are going to equal our sales less the returns and allowances and discounts. 17,980. We'll put our cost of goods sold. Again, we can look right here. See the balance is 11,660. And cost of goods sold, so net sales minus cost of goods sold gives us our gross profit. So there's our gross profit. We'll look back at the problem again. Let's say calculate the profit margin and the gross profit rate. Assume operating expenses were $3,000. Okay, so what I'm going to do is I'm actually going to finish this so I can figure out my net profit. So operating so our net income would be our gross profit minus our operating expenses. And then it asks for the gross profit margin. Or gross profit rate, I think is the term they used. And to find that, we take our gross profit and divide that by our net sales. And then instead of expressing it as dollars, we express it as a percentage. Let's get one decimal place in there. And then our profit margin, sometimes it's called the net profit margin. That is our net income divided by our net sales. Again, we're going to want to tell Excel this should be a percentage, and we want a decimal. And that's it. That's the whole problem.